Joining us now is FBB Capital Partners Director of Research, Mike Bailey, and of course, Surat. Mike, you're nodding, you're smiling. Netflix is great, and I'm not taking anything away from Netflix. Is Netflix, though, representative of the macro market? I don't think so.
It is a bit of an outlier. So, great company. We own it at our firm, and they're exceeding investor expectations. That's great. However, if you put that in the context of everything else, really, there's a few company-specific things that are helping Netflix out. So we congratulate them. It's great. It's a good position, but you got to stay diversified. You got to make sure you own a little bit of everything. Not every company is going to have just massive blowout quarters like Netflix. You want to own a little bit of some more moderate risk return type of names as well. But it's a good company, and it is an example of a broader theme in tech we're seeing, which is general underlying growth. The economy is doing pretty well. People have jobs out there buying things. That trickles down to even a lot of the tech companies as far as some of the growth we're seeing. So good to see it, and it seems like we've got some more on the way.
So I think that's an interesting question. We were debating last hour, Mike, whether you should be going into small caps or not, primarily because the argument is, the valuation is cheaper, the S&P is overpriced, and how does that kind of jive with you?
Yeah, good question. I think in general, we would probably stick with larger cap companies. I think the real critical piece for us is their earnings growth. If you were to break out every company, that's out there and say, okay, who has the greatest opportunity to meet or exceed what investors are looking for as far as growth? At this point, large cap really grabs our attention. Small caps, absolutely, they're trading a little bit cheaper. If there's some type of short economic cycle and then a recovery, absolutely, that's a good way to play it. But if you want to own things longer term, if you want to really have high conviction that these companies can set a goal and exceed it, at this point, large caps seem like a much better place to play for us.
Well, I don't want to have low conviction, Surat. I will say I want to have high conviction. I don't want to have low conviction. You get my point. We talk, Surat, about all the same names all the time, right? And I don't mean just this show. I mean because they're performing. Are there any companies we're missing? It's got to be. I mean, there's thousands of companies out there.
There are a lot of companies you're missing because where we focus on is the 10
NVIDIA.
stocks. Well, the 10 stocks that make up 50% of the market, and that's the one that most people are either invested in or interested in. But you can look outside that universe, and there are plenty of other companies out there. In the energy patch, you can look at Schlumberger, which is selling at 9 times earnings and has a 3% dividend yield. So a company like that, which has 5 to 7% earnings growth, if not more.
I've heard of them.
Yeah, I was going to say, Mike, any that you would mention?
Yeah, I definitely agree. I think a lot of the excitement is kind of, sucked up into those top 10 names in the S&P 500. There's some great names there, but there's plenty more after you go down the list. I know some other things where you are getting nice growth. There are companies that can meet or exceed. It's a little bit down the list. Eli Lilly, for example, so drug company, has nothing to do with AI, and that's totally fine. It's growing, 2 to 3 times faster than the broader market as far as earnings, and trading just a little bit of a higher premium. So that's something that looks very interesting. We can stick with the AI theme, but just kind of diversify even more. You can look at, speaking of energy, for example, NextEra. So it's a utility. It's getting involved in a lot of the wind and solar. A lot of that stuff is going to power some of these new data centers, trading at a big discount. Some investors are worried companies like this with wind and solar may have some challenges with the new administration. This company in particular, same multiple as Trump 1.0, same earnings growth rate. NextEra did very well in the first Trump administration. So a lot of names out there beyond the top 10 that look pretty compelling.